Okay, it's time to bring the semester to a close and bring this class home. So the last piece we're going to talk about is financial planning and control, essentially what happens at the corporation or not-for-profit entity or governmental entity to kind of bring all these pieces together from a financial planning, control, and operations perspective. So financial planning is a projection of sales, income, and assets, as well as a determination of the resources needed to achieve the projections. Essentially, what are you going to do and how are you going to pay for it, both in terms of the income statement projections as well as the balance sheet projections. And financial controls deal with the feedback and adjustment process required to ensure adherence to plans as well as modifications of plans as a result of unforeseen future changes. Unlike accounting, where you've got accounting financial controls, which revolve around the ability to control funds and make sure that they're being spent properly. On the finance side, financial controls are more focused around the ability to understand what's going to happen from a forecasting perspective and make adjustments to those forecasts so that, as we talked about in the last couple chapters, you don't run out of cash, which is your lifeblood of your company. The first part of financial planning is the sales forecast. It's a forecast of the firm's unit and dollar sales for some future period, and forecasts are generally based on recent sales trends plus forecasts of the economic prospects for the nation, region, industry, so forth. Just a little story. I today just had a meeting with my sales team as well as my operations team to do the sales forecasting process. My CFO was there as well. And sales folks don't necessarily like this forecasting piece because they feel like, one, they're being held accountable to it, and to some extent they are. And two, there's always some things may change, and this is true. And that's where we go back to the financial control discussion that we talked about on the last slide. But, we do these things. Everything I'm talking about in this particular section is done on a regular basis by most companies in order to keep the wheels on and keep the bank account full. So this sales forecasting process, sales folks generally hate it. And if you are in sales or end up going into sales after you get out of school, you're going to find that you hate it too. But it's part of business, and don't view it as a negative. Understand why this is being done. So from that sales forecast, you're going to build pro forma financial statements, and they're forecast financial statements. So you're looking forward and you're trying to understand what requirements you're going to need on the credit side or on the equity side. So essentially, how are you going to accomplish what you're looking to accomplish with your business plan? And the AFN is the additional funds needed to support the additional level of forecasted operations. So if you're going to need to go out and raise additional debt, and we saw that on the Unilate example when we did the cash forecast, and we saw that they were short, $70+ million. That's why you do these forecasts. You look at the sales forecast that feeds through your expense forecast. You end up with a cash forecast, and once you get to that cash forecast based upon pro forma financial statements, you then recognize how much additional financing is needed, and then you move forward to be able to secure those additional funds, or you have to go back and adjust your plan accordingly. When you're doing your pro forma financials, you're going to need to determine how much money the firm needs in a given period, or determine how much money the firm will generate internally. And again, there may be a surplus. So the difference between funds generated internally and funds required to attain forecasted assets represent the external financial requirements, termed the additional funds needed, the AFN. I've never used AFN in real life. I've always used cash shortfall or additional funds needed. And, hopefully you're not in an AFN situation, you're actually in a surplus. And that's going to be, if you're in a surplus situation, that's where we'll talk about that in a little bit. But that's where you may be looking at a dividend or looking to crawl through those projects that you may have passed up and see if any now meet the hurdle requirement or the necessary return on investment to proceed. So when you're forecasting the income statement, you start with step one, which is, and we're going to walk through this with Unilate. So the assumptions are that Unilate operated at full capacity in the most recent year. Sales are expected to grow by 10%. So if it's operating at full capacity and sales are going up by 10%, that means that there's going to need to be some additional investment in property, plant, and equipment in order to make that happen, as well as potentially inventory, accounts receivable, etc. Variable cost ratio remains at 82%, same as previous year. And the next year's dividend per share will be the same as in the previous year. So no increase in dividends. We're going with a steady dividend model. So let's take a look at the financial statements. The 2018 actual results are here. $25 million addition to retained earnings, and we paid out $29 million in common dividends. So the forecast says we're going up by 10%. So here's your sales piece. Cost of goods sold also goes up by 10%. So that's the gross profit. Then you've got fixed operating costs are going to go up by 10% because you're operating at full capacity. So you're going to need to increase your fixed operating costs plus your depreciation because you're going to need additional property, plant, equipment. So now you've got EBIT goes up by 10% from 130 to 143. Interest stays the same at $40 million because we haven't determined whether we have net borrowings yet. So earnings before taxes goes up the same $13 million, but now you're starting to get more than a 10% increase. Taxes remain at 40%. Net income goes from $54 million to $61.8. We pay out $29 million in common dividends. We saw that in the assumptions. There was no change in common dividends. Therefore, the additional retained earnings goes from $25 million to $32.8 million. And you could just do the math yourself to see how that came out. So step 2, we recognize that Unilate operated at full capacity for the most recent year. So the assets need to grow at the same rate of sales to attain 10% growth. And spontaneously generated funds, accruals and payables, are going to grow at the same rate. So let's take a look at that. So cash needs to go up by 10%. So that's a $1.5 million increase in cash. Accounts receivable goes up by 10%. That's $18 million increase in accounts receivable. Inventory goes up by 10%. So that's a $27 million in inventory increase. So total current assets go from $46.5 million to $511,500,000. The net property, plant, and equipment go from $380 up 10% to $418. So that's $38. The total assets go from $845 to $929.5 for an increase of $84.5 million in increased net assets. So you can see, based upon the assumptions, your forecast says all these elements are going to go up by 10% because you were operating at full capacity last year, which results in an $84.5 million increase to assets to get the 10% increase in sales. So how does that get funded? Well, we fund it this way. We say accounts payable is going to go up by 10%, so that's $3 million. Accruals go up by 10%, that's $6 million. Notes payable don't change. So current liabilities go up by $9 million. Long-term bonds don't change. Total liabilities go up by $9 million. Common stock stays at 130 because we didn't issue any new common stock yet. Retained earnings, when we did the income statement, we saw that goes up by $32.8 million. So retained earnings, it goes up by $32.8 million. So total owner's equity goes up by 415, from 415 to 447. It goes up by essentially that 41. It goes up by 32.8 million. So total liabilities plus equity goes from 845, which is the equity plus the liabilities amount, to 886.8, the liabilities plus the equity amount. So that comes out to an increase of 41.8 million. So if we said, okay, we know that we generated 41.8 million in additional cash from operations and from spontaneous creation of increased accounts payable and accruals, from the amount that we said we needed in the last slide, $84.5 million, we need to generate an additional $42.7 million of cash. So there's additional funds needed of $42.7 million. How are we going to come up with those additional funds? So higher sales must be supported by higher assets. Increases in assets can be financed by spontaneous increases in AP and accruals. Any shortfall should be financed from external sources of funds. It needs to be financed from external sources of funds. That is by borrowing or by selling new stock. The additional funds needed is at 929.5 million minus 886.8 million, or the 42.7 million that we just saw. So how are we going to get that? The effects of the income statement and balance sheet result from actions taken to finance the forecasted increases in assets by issuing new equity, new debt, or both actually need to flow through. So it's not just I'm plugging 42.7 million. It's actually, you're going to need a little bit more than that potentially, because you got to cover additional dividends. You may need to cover additional interest. You're going to need to deal with flotation costs. And so it now starts becoming almost, if you're an Excel person, it's almost like a circular reference. You're trying to solve for something, and every time you increase it, it increases the amount that you're trying to solve for. So, and I just mentioned that second bullet, we need to figure out how to make that flow through the balance sheet income statement for the additional funds needed. So in this particular case, we've got the EBIT is at 143 for the forecast, for the initial forecast, less interest. We're going to assume that we've got a change in the balance sheet. And I'm going to talk through the balance sheet changes in a minute. The interest goes from 40 million to 41.4 million. So we're going to have an additional $1.4 million of interest expense. So our earnings before taxes will go from 103 to 101.6. Goes down by the amount of additional interest paid. Taxes also go down, however. We get a tax shield associated with that interest payment. So the net income goes from 61.8 to 61. Common dividends go from 29 to 30.5. We're going to show you where the assumption was on how much additional common stock is issued. So the addition to retained earnings goes from 32.8 to 30.5. And again, that's just flowing this down. So you've got a minus $2.3 million in the addition to retained earnings side. The upper portion of the income statement, so from sales through to EBIT, isn't affected by financing feedbacks. And that's one of the reasons why you have EBIT as a critical measurement, because when you're determining how you're actually going to fund your balance sheet, so the right side of the balance sheet or the bottom of the balance sheet, EBIT, which is your operations income, isn't impacted. This is what's impacted. So that's one of the reasons why you have these things called EBIT and EBITDA. The adjusted forecast for the balance sheet, so total assets needed to be at 929.5 million. Accounts payable went up by 3 million. Accruals went up by 6 million. Notes payable stayed the same. However, we're going to have a financing adjustment here because we need that 42.7. We know that there's a negative 2.3 impact to retained earnings if we do 6.8 million of notes payable, 9 million of long-term bonds, and 29.2 million of common stock is the issuance. So if we have additional funds needed of 45 million, minus 2.3 gives us the 42.7 million net that we needed to be able to grow the sales by the 10% amount. So a few of the ratios change as well. You have the 2018 ratios, current ratio 3.6, inventory turnover 4.6, day sales outstanding 43.2, total asset turnover, debt ratio, times interest earned, profit margin, return on assets, and return on equity. You can see with the adjusted industry average, the current ratio goes down a little bit. The inventory turnover goes up. This is a good sign. DSO doesn't change. There's might be an opportunity to get some cash here. If you got closer to this amount, we're going to calculate a little bit what we might be able to find here. You've got total asset turnover is 1.8. It's a little worse than the industry average. Debt ratio is going down because you issued a bunch of new common stock. Times interest earned goes up, which is good, but we're still not anywhere close to the industry average. Profit margin goes up, but not to where the industry average is. Return on assets goes up, and return on equity goes down because we issued a significant amount of additional common stock. So if excess capacity exists, a firm can increase sales to the point that the unused capacity is used. So if you're at full capacity sales, again, the assumption in the last slide was that you were at full capacity. If you're not at full capacity, you can calculate what full capacity sales are by simply saying, what's my current sales level and what's my current percentage of capacity? Divide that current percentage of capacity into the current sales level, and you can determine how much more headroom you have before you have to begin expanding your asset base. There's a few other things to consider when you're looking at economies of scale. So the Unilite's variable cost ratio is 82% of sales, and you might see some economies of scale to the point where the ratio might decrease to 80%. So you might be able to drive some cost out of the business if you're able to become more efficient due to some economies of scale. The changes in the variable cost ratio will impact the forecast in addition to the retained earnings, which then impact AFN. So again, it's important when you're looking at the financial forecasting piece, this is above that EBIT line. It's important to really scrub through your operating assumptions and understand what your real capacity is and how much you can squeeze out of your existing capacity. And if you buy new property, plant, and equipment, whether there's going to be any economies of scale associated with it, or whether you may be able to have different segments of an assembly line, for instance, has additional throughput capacity, so you're not going to increase everything by 10%. It may be that the increase is by 8% or 7% on a property, plant, and equipment, which is going to impact your AFN as well. So understanding the operations of the business and how that impacts your balance sheet is really important as you're going through this process. The other piece is lumpy assets. So lumpy assets aren't bad pillows. Lumpy assets are things that are acquired by step function. So obtained in large discrete amount. Examples of this would be real estate. So a building, you can't just add 10% of building. It's generally going to be, I'm going to build another building, which is a significant increase. If you need to buy a new big piece of equipment, that equipment, to go from widget number 1000, where you're at 100% capacity, to widget number 1001, you may need to buy another piece of equipment that adds a capacity of 1000 widgets. Because that's the only size that's available. And so you have these lumpy assets where essentially, if you're into math, it's essentially a step function where it stays flat. So your total cost on a fixed cost side stay flat until you hit that 1001st widget in this example, in which case you then have to expend a significant amount of money for another machine. But that new machine will then, you won't have to buy another machine again until your capacity equals 2001 widgets. And so as a result, that 1001st widget creates a lumpy asset step function where you have to make that investment. But then widget number 1002 through 1999 or 2000 don't require any additional machine investment. There's a few other factors that impact the additional funds needed forecast. If you change the dividend payout ratio, so if that decreases, if you say my payout ratio is going to be lower, then you retain more cash. But the reason you might not want to do that is all the signaling discussion that we talked about a couple chapters ago. Profit margin changes. So if you're able to increase your profit margin through economies of scale or through cutting some of your fixed overhead or refinance your debt, for instance, total income, retained earnings increase, and that reduces your additional funds needed. If the plant capacity changes, so if you use less capacity, there's less need for additional funds because you don't need to buy those additional assets. And this is the discussion that we talked about. Accounts payable terms increase to 60 days. So if you take your accounts payable and you say, I'm not paying vendors, right now we pay vendors at 30 days. If you say, I'm not going to pay vendors till 60 days, you create an additional spontaneous liability, which then will double your accounts payable, which increases your liabilities, but also causes you to hold cash for an additional 30 days, which reduces your additional funds needed. You create a spontaneous liability. So when you get to budgeting and leverage. That's the phase where the financial plans are actually implemented. So now you've got your financial plan. It should tie to your strategic plan. You should be integrated when you're building these as part of your management team with the operations team, with the sales team. We talked about the sales forecasting piece. The operations team will help you understand what the capacity is and what it's going to take to increase capacity. You're going to want to work with your executive team and your human resources team to understand what the benefit costs and other inputs, labor inputs are, as well as what the strategic vision for the organization is, as well as any new products or services that may need to be purchased. You're going to want to work with your facilities team to understand if there's any additional maintenance or other items outside of normal that need to be factored in. Once you get to that point, you're now at the budgeting phase. And the budgeting phase is where the financial plan is implemented. And financial control deals with the feedback and adjustment to processes required to ensure the firm is following the right financial path to accomplish its goals, and if not, to make necessary corrections. So I go through this on a monthly basis with my CFO today, where we sit down, we go through the budget, we go through where there's budget variances, so whether they're favorable or unfavorable and why they existed. If the budget variances are permanent, we adjust the forecast, which then will impact the additional funds needed for the remainder of the year associated with our financial forecast. And so again, this happens in real life, and going through that financial control process is really the process of sitting down and scrubbing the financial plan and budget against the actuals and understanding where there's variance and trying to manage that variance or translate that variance into new expected performance. So operating break-even analysis is an analytic technique for studying the relationship between sales and revenues, operating costs, and profits. Operating break-even analysis only deals with the upper portion of the income statement above the net operating income line, which is the operating section. At the operating break-even point, EBIT equals 0. So in Unilate's case, this was the forecasted operating income. We had $1.65 billion. You had your variable costs, which gave us a gross profit of $297, fixed operating costs of $154, which gives us net operating income, EBIT, of $143. So if we then plot this and try and figure out where the 0 point is, we plot this out and you can see that the operating break even is actually at 855.6 units of sales. At 855.6 units of sales here, this becomes 0. This changes and this changes to reflect the per unit basis of sales. Fixed operating costs remain the same. You can see fixed operating costs are here. Oh, so sales is at 855.6. The quantity of sales is 57.04. Once we get below 57.04 million units, we start running an operating loss. Once we're above 57.04, we run an operating profit. It's easy enough to calculate what that is when you're looking at operating break-even computation. You've got your forecasted sales amount over the contribution margin for the quantity of break-even, or for sales of operating break-even, you've got your forecasted sales amount over the gross profit margin. It's easy enough to calculate what these elements are. For the quantity for operating break-even, it's going to be your fixed operating cost divided by the contribution margin. And for sales break-even, it's going to be your fixed operating costs over your gross profit margin. And we'll see that here for Unilate. So here's the example for Unilate. Unilate sells its products for $15 per unit. The variable cost per unit is $12.30, and the fixed operating costs equal $154 million. This is given. So you use your fixed operating cost, $154 million, over your contribution margin, which is 15 minus $12.30. So you get $2.70 contribution margin against the fixed operating costs. And so as a result, if you divide $2.70 into $154 million, you get 57.04 million units is the operating break even in quantity, assuming a sale price of 15 and a contribution margin of 12.30. And for sales at that same level, all you have to do is make that calculation a little bit differently, which is you're going to be looking at the contribution margin here, which is 18%. So, you know that because we also said the variable costs were 72% or 82%, excuse me. And so you know that this is going to be 18%, which is 100 minus 82. And then you divide the 18% into 154 million of fixed operating costs, which means any sales below $855.6 million result in an operating loss. Operating leverage is really driven by the existence of these fixed operating costs. They magnify the change in operating income. If you were 100% variable, you would have a fixed profit per unit, and that fixed profit per unit wouldn't impact fixed operating costs at all because you'd have none. If you have all fixed operating costs, every additional unit you spend, you sell, once you get over the fixed operating cost amount, drops directly to profit. And so that's called operating leverage. And the degree of operating leverage is a percentage change in net operating income, or EBIT, associated with a given percentage change in sales. The degree of operating leverage is the percent change in net operating income over the percent change in sales. And you can calculate that here. You can see that this is the quantity of sales units times the contribution margin for each, and then over the quantity times the contribution margin minus the fixed costs. And that's also equal to sales minus variable costs, and sales minus variable costs over fixed costs, which is a gross profit over the EBIT. In Unilate's case, if you go through and calculate at sales of 110 million, 121 million, and you increase it by 10%, you can see the revenues at 110 million and revenues at or variable costs at 110 million units gives you a gross profit of $297 million minus fixed operating costs of 154 because that's fixed. So your net operating income is 143. If sales increase by 10%, this element increases by 10%, the variable pieces, which gives you a gross profit of 326.7, which went up by 10%. But because your fixed operating costs remain fixed, you didn't increase it. So a 10% increase in sales results in a 20.8% increase in net operating income. Go from 143 to 172.7 because there was no need to increase your fixed operating costs given this calculation. When you're looking at financial break-even analysis and you're determining the operating income the firm must generate to cover all of its fixed financing costs, produce earnings per share equal to zero. At the financial break-even point, earnings per share equals zero, and that can be plotted as well. So essentially, this is the point at which you're covering your fixed financing costs, and so the financial break-even point for Unilate is $41.4 million, which is where the interest expense amount was. The financial break-even computation is the point at which earnings per share equals zero. And so in order to calculate where earnings per share equals zero, you follow this formula. Essentially, you take a look at the earnings before interest and taxes and subtract out the interest, because that needs to be paid, and you've got a tax shield on that. So that's 1 times 1 minus the tax rate. So this piece times 1 minus the tax rate, that gives you your after-tax earnings. And then you've got minus preferred stock dividends, because those also need to be paid over the number of shares. Where that equals zero, that's your financial break-even. So generally, we're going to be solving for EBIT, because we'll know what I is. This is fixed based upon the debt. We know what T is, that's your tax rate, and we know what D, the dividends on preferred stock is, because we know what the preferred stock outstanding is and what the dividends are, so that'll allow you to solve for EBIT. The way to look at that in this particular case, is EBIT, the financial break-even, equals interest plus the dividends on preferred stock over 1 minus T. That's essentially manipulating the formula we just talked about. And a financial break-even point for Unilate is $41.4 million of interest expense. There was no outstanding preferred stock, and so the total is $41.4 million. When we look at financial leverage, the existence of fixed financial costs such as interest and preferred dividends, when there's a change in EBIT, that results in a large change in earnings per share. Because again, once you've covered that fixed financing cost, then everything else falls to profit. And so that's called financial leverage. The degree of financial leverage is a percentage of change in earnings per share associated with a given percentage change in EBIT. Calculate that. The degree of financial leverage is equal to the percentage change in earnings per share over the percentage change in EBIT. That's calculated right here, and we'll walk through that for Unilate. The degree of financial leverage is EBIT over EBIT minus EBIT at financial break-even, or EBIT over EBIT minus I, where the dividends on preferred stock equals 0. So in Unilate's case, at sales levels of 110 and 121 million, 10% higher, you can see that EBIT goes from 143 to 172.7. It goes up by 20.8. We showed how that worked based on operating leverage. Interest is 41.4. If sales are 10%, there's no change. This should say negative 41.4. There's no change in interest, so 0. So earnings before taxes go from 101.6 to 131.3, goes up by 29.7. That's a 29.2% increase in earnings before taxes because the interest, that fixed financing amount, didn't change. So this is the financial leverage. Taxes at 40%, net income goes up by 29.2, earnings per share goes up by 29.2%. It goes from $2.32 to $3. Again, taking a step back, you can see the operating leverage caused the increase of 10% in sales to turn into 20.8% increase in earnings before interest and taxes. And a financial leverage caused a 20.8% change in net operating income or earnings before interest and taxes to turn into a 29.2% increase in earnings per share. So you see that that's what leverage means, is essentially for a small change here, you use a lever of operating leverage and financial leverage to go plus 10% equals plus 29.2. Now this works the other direction as well. So if this went down by 10%, you'd probably see about a net minus 30% here because you still have these fixed amounts to pay, whether that's the interest fixed amount or whether it's the operating fixed amount in the operating leverage calculation. So total leverage is the existence of fixed costs, fixed operating costs, fixed financing costs, or both types of fixed costs. And when there's a change in sales when a small change in sales results in a larger change in earnings per share. The degree of total leverage is a percentage change in earnings per share associated with a given percentage change in sales. And again, we just walked through that. I'll show you the calculation. You've got degree of total leverage is the degree of operating leverage times the degree of financial leverage. And that entire formula kind of washes down to sales minus variable costs over EBIT minus I. So looking at the degree of total leverage for Unilate, you're looking at a 2.92 times. So essentially, and we've walked through what these calculations are, but you can see what that is. It's 10% change in sales results in a 29.2% change in earnings per share. So to get from 10% to 29.2%, you multiply by 2.92. And essentially that's going to be multiplying. You're going to take the degree of operating leverage, which gets you to the 20.8. Then you're going to take your degree of financial leverage, which gets you to the 29.2. And that's how we get to a 2.92 times degree of total leverage. If projected operating results aren't satisfactory, management needs to reformulate its plan. So when you're looking at a company and that company is performing well, that's all fine and good. If the company starts performing outside of expected forecast, and usually they perform to the downside, unfortunately, you need to reformulate your plans. That may mean that you're looking at deferring, reducing hires. That may mean you're reducing expenses. You may be doing layoffs. And so you need to reformulate your plans, which will impact your additional funds needed, your sales forecast, your cash forecast. If the funds required to meet the sales forecast can't be obtained, management has to scale back its projected level of operations. If you can't buy that additional equipment or you can't fund the additional inventory needed, you have to make an adjustment to your plans. And it's best to plan to raise funds well in advance of when they're needed. There's an old adage that a banker will happily lend you money when you don't need it and won't lend you money when you do, because when you do need it, you're generally showing some level of financial distress. When you don't need it is generally when you're really profitable, and that's when banks want to lend you money. So again, if you're in a financial planning and analysis role, or you're in a chief financial officer's role, or you're an entrepreneur and you're in a chief executive officer's role, remember to secure your bank financing commitments prior to actually needing the cash, because once you really, really need it, if you're getting desperate, it's going to be very expensive if you can get it at all. And then any deviation from projections need to be handled to improve future forecasts. So as you're starting to see changes in sales forecasts relative to or sales actuals relative to the forecast, or deviations in your budget to actuals, you need to update your financial forecasts so that you can then update your cash forecast so you know what you need to do in order to be able to fund operations.